Welcome back to the channel. Today I wanted to cover a more fun topic, and at the start of the year I created 10 UK stocks to buy in 2021. And at the start of the year I picked 10 names. Some of them I knew already and some of them I didn't, and I want to see how well they've done. And this was actually a video suggestion by a commenter, a regular on the channel actually, by the name of Jason. I thought this would be quite an exciting but also informative idea. And originally I was going to put a thumbnail saying I was wrong. I was very much expecting a lot of these stock picks to be greatly down, but instead it seems like my judgment was clouded by only one big loser aside from the rest of them that I think have done pretty well. And if you like the video, please drop one of these to help beat that YouTube algorithm. So to start, the first stock pick that I did mention was the likes of TSTL or Tristel, which is a cleaning and decontamination products manufacturer. And basically these were more of a safe, predictable bet with consistent reoccurring cash flow and earnings that meant that over the longer term it's probably a structurally sound investment. They did have a dip at one point. I think that may have been when I suggested to buy this stock, as the shares have gone up by 11.94% since, which for a predictable stock I think makes a lot of sense. Originally I believe I marketed this towards the more dividend investor, someone who wanted a lower volatility stock, and I think Tristel achieved that much. Although I do want to pick on another stock, and this is one I actually held for a while, and this is Halma. Halma is a stock that I probably ended up buying and selling out of for a very little profit. Whereas if I'd have continued holding, I would very much be up around about 20.72% on the investment if I'd have bought when I made the video. Halma is an interesting company because they are a company that invests in other smaller businesses and then creates that into their own bigger business and then uses that. It's a very niche business that works in health safety systems, such as like elevator safety systems, for example. And so they can get these niche mechanical engineering businesses, acquire them, make them more profitable, and then if they choose to, they could dispose of them in the future. A lot of their, let's say, share price driving factors are the facts of due to the likes of their mergers and acquisitions, which they're frequently buying more companies or disposing of them. I personally actually had sold this investment because they made an acquisition in the US and I thought it was an overvalued software acquisition. I felt that a company of this size, that they're not going to generate as strong shareholder returns or more effective returns on their capital employed because they're a bigger company. As their cash flow increases, they still want to spend down that money. So what are they left to do? I wasn't too sure. And yes, they could keep investing, but it seemed like the quality of the investments were lower because obviously you could get a very high quality £1 million business, but they're difficult to find. And would it really be worth the time to acquire that £1 million business if you've got £100 million that you need to use effectively in mergers and acquisitions? Regardless, another one of these more safer, more dividend plays, but did have a fair bit of growth. Another one in a similar boat to this was Gamma Communications. One that I really like the prospects of. Again, safe, predictable. The trends are here, and the first three that I've mentioned so far, all of these stocks had very strong balance sheets. These stocks had high profit margins. They had consistent and predictable earnings growth alongside revenue growth, and they usually had high returns on capital. This is already interesting to see because although I should note that it has only been an 8 to 9 month period because I made the video on December 23rd. I used the dates 22nd to track it as that's when I would have probably recorded it. And we can see that things are a little different because this is only 9 months. This is still very much short term. I thought, as I said, it'd be an exciting but also informative topic because why not show you if they were winners or losers? Because after all, I did pick 10 of them and it was one of my most viewed videos on the channel. I digress slightly, but Gamma I think is a very high quality stock. It's one that is still on my watch list alongside Halma as well if I could get a more of attractive valuation. But sometimes a lesson to be learnt here is that some of the highest quality stocks stay at premium valuation for a very long time and may never drop too low. And so whilst I could try and implement the idea of patience, something I've had success with more recently, it may not be the effective strategy for such strong quality stocks like those. However, one stock I was at least somewhat wrong about was the likes of the London Stock Exchange Group. I bought into this stock because I was very bullish on the acquisition on Refinitiv. Don't get me wrong, the combined company is very much very strong. However, I definitely overestimated the impacts of the acquisition on the business and what it would drive the share price, because it ultimately ended up happening where the shares had dropped. I remember going, okay, look, they've now acquired Refinitiv. They're now saying it's going to take longer than needed to really implement and get together. At that moment, I thought, you know what? I'm holding it, but I'm not really doing anything with this position. I'm not buying more. It's dipped. I'm just going to sell the position. I think I got stopped out at around about £83 per share, which is actually still higher than what it is today. But I recommended them for, again, a very predictable, high defensive... I should mention this too. All of these companies have very strong moats, meaning that other businesses will struggle to get competitive advantages over them because they've already laid out strong fortifications. London Stock Exchange Group is one of those as well, because it's very rare that you come across a stock exchange. And then we've also got protections in place. Obviously, we have got very notable and big stock exchanges across the globe, but would there be a point where if they combined, much like how we had London Stock Exchange and Refinitiv combining, would there be a point where countries would be like, actually, hang on, this is a bit too much power for one business, stay apart? And because of this, this means companies like the London Stock Exchange Group can continue to be profitable, can continue to give out dividends and use their cash flow to pay. And then obviously the technology in this sector can be quite exciting for the future, because I'm quite a strong believer in financial technology. And so this would have been one that I picked, although I personally sold out of because at the time I was trying to seek more risk. And I think the decision was well timed, although probably not the wisest. But then it's easy to look back at our decisions and go, well, that was a mistake, because everything's easy in hindsight. After all, another quote that I've mentioned before from a commenter that was saying, it's easy to win Sunday's lotto with Monday's newspaper. And if you'd like to sign up to my stockbroker Freetrade, you can actually get a free share worth up to £200 if you use my link in the description down below. Or if you served up to the likes of Curve, you can get £5 when you first spend on the card. Again, link in the description down below. Interestingly, two of the stocks I actually hold in my portfolio since December 23rd have not done that well at all, which is quite funny actually, because in looking at the entire list, aside from the London Stock Exchange Group, which is one of the worst performers, which I did hold but managed to sell out of with a tidy profit, well, not even a slight profit, the other two stocks that did the worst are the likes of Team 17, which is only up by 0.89%, and Games Workshop, which is only up by 6.52%. Team 17 has been very volatile in this time, in fact, and that's due to the excitement in the industry. There's been a lot of potential acquisitions, valuations were pushed up, and lately shares have then cooled down again. They did make some good strategic acquisitions of an edutainment application, software provider, or developer even, and I felt this was a very good move in unifying and creating a more diversified base, but also really building upon their consumer base, because I said that I felt there was more of an all-age appeal to this. So getting these edutainment applications designed for young ages could certainly bring them in to the whole atmosphere, and then they could perhaps in the future be like, oh look, this Worms character was in this game. I like that Worms. I want to play this game. And it may just create subliminal signals that may want them to play those games in the future. And unshockingly, they've not done very well in the short term, at least since when I created the video, because at that time they may have been at a higher valuation. After all, it is still a short-term period, and over the longer term they may have a fantastic run-up. As a lot of micro and small cap investors do say, that you could have 4 bad years, but all it takes is one cracking year, and all of those returns are very much made up for, and your CAGR would still be very strong. And then the likes of Games Workshop, which I am actually the most bullish on of all of the companies, is only up by 6.52%. There's a lot of excitement in the area, but then valuations were already high for this stock. They've got their Warhammer subscription model coming out very soon. And they've also got the likes of some of the video games such as Total War Warhammer 3 coming out later in the year, and that should be exciting for the royalties. What was very impressive about this company is that they were able to grow their revenue in Northern America by such a significant amount, and it is their largest consumer base. I felt the growth there was very strong, and it's showing that there is becoming more of a larger acceptance to the universe of Warhammer, and this is a play on intellectual property, which I think will begin to dominate over that longer term period. We're already seeing it in place. It's more commonplace. It's more socially acceptable to talk about these things. It seems like is it nerd or geek culture, whatever it is, it seems more acceptable. And that, I think, is a very good sign. And in the future, I think they're going to do well, especially if they move into the likes of TV series and films, which with their subscription, they are planning to do an animated TV series, which I will be interested to see. And then possibly the best stock pick that I made on December 23rd was the likes of FUTR or Future PLC. And immediately when I saw this company, my contrarian mindset was kicking in. I saw a company that used or still does provide magazines. I'm talking like the old school Xbox OXM magazines and many other hobbyist style of magazines. I thought, you know what, this is brilliant, because if you're going to buy a magazine, you're going to do it in something you enjoy. And if you have a hobby, a passion for something, you're going to spend money on that, whether it's a magazine or not. And I know this because I used to, when I was younger, get some of those magazines, and I felt it was very much interesting just flicking through that, even if I wasn't one that really read and would just prefer to jump on a computer system and play games all day. It was very much that contrarian play. And then I heard that they were looking for another company that were looking to dominate in intellectual property. They were looking to invest in different websites and different domains so that they are able to create a cohesive network of sites that all interlock, so they could get data from, for instance, what was the one, Go Compare, where it's car insurance and other insurance providing software, comparison websites. They could get the data from that and then apply it to specific advertising, and it becomes all quite a conglomerate, but a very well managed one. I think at the time I was a bit suspicious because that Go Compare acquisition may not have gone too well and the valuation was already very high, but since then shares have more than doubled. Although this one wasn't on the list, but I feel it's very much mentioned, because if I had the time to make this video, I would have gone through all of the monthly ones as well to see how all of those stock picks have done. But the most notable one I would have mentioned is the likes of Best of the Best, or BOTB. As far as I remember, the first time I mentioned this stock, or at least one of the first few times, was during a UK stock tip of the week, a series that did not actually continue. This was a stock that I recommended because they were making so much money. They were basically an online gaming company where you would enter for competitions to win luxury cars. And during the lockdowns, they were making a lot of money because obviously gambling websites, they were like not driving revenue because the sports were off mainly. So it was only the casinos that were really pulling cash flow through. Because people were in lockdowns, they were saving more money, they had more discretionary spend, leading to massive revenue and earnings growth of Best of the Best. In fact, they had a payout ratio that was so minor that I thought they could really amp that up in the future if they needed to, or continue to grow the business, especially because their advert impression rate was so effective that I believe it was something like an advert would cost 3 months of a customer's regular engagement in the business, which they usually did, to be profitable, which was very interesting to me. However, unlike the other stocks on this list, they didn't actually have a moat, and very much they were very, very exposed to the likes of discretionary spend. And so it was certainly a riskier stock, and since then shares have dropped by 66.45%. This is yet another stock that I did buy a few shares of. Only a small amount, I'm talking less than 20 shares. And I bought this when they originally dipped to around about £17 per share. And now they're trading at around about £7 per share. And it just goes to show that even though I'm on YouTube, even though I'm making videos twice a week on investing, and I'm looking directly at the UK markets, I will be wrong. And in fact, I think everyone will be wrong in the markets. And as I said, I'm very surprised at how well a majority of this list have done. And if anything, it's showing me, right, I need to continue investing in these companies with strong moats. I need to perhaps lower the risk slightly because the companies on there are actually really high quality and done very well. Another notable one is Dph Decre Pharmaceuticals. I like their dividend history of this company, although I was a little bit more concerned about their overall revenue growth and earnings growth because they'd done so well in the past, and they were a pharmaceutical company directly targeting veterinary products and, for instance, pets. I felt that people are more willing to spend money on them pets than they are their own health, more of a pampered lifestyle for their pets. And so I felt that this one would have done well, and so far it has. Although I would like to see these stocks perhaps more over a longer term period, because Whilst a lot of these have done well now, perhaps the overall market movements have been high. From checking, it's important to notice that the FTSE 100 has gained 11.07%. So it would suggest that a lot of these stocks, well, I think about 5 of them have underperformed the market, but 6 of them have outperformed, and by good margins. Decre Pharmaceuticals gained 52.8% and had done very well. And the last stock that I mentioned was Yougov, a survey provider that got a lot of information and marketing through that, and they created their own packages for business so that they could effectively target their audience demographics. This was again more of a safer built-up play. This was a very highly and richly valued stock, and yet they continue to climb. I felt that their revenue and earnings were a bit too priced in for the next 5 to 10 years, and I felt that if they had more of a negative earnings or revenue trend, or let's say guidance, that I thought shares were really going to drop back down and realize a more realistic valuation. But since I mentioned them, shares are up 30.61%. As I mentioned before, I'm currently reading The Art of Execution, link in the description down below, by Freeman. What I've learned from this is, I think in these situations, if I had invested, let's say, since it's best of the best as well, about 9% into each and every one of these stocks, I think I would have done quite well. However, a lot of my performance would have been wiped out by some of the losers, especially best of the best. And it goes to show, and I think a rule that I think anyone should have, is if a stock drops by 20%, that you should take the moment to really think about that stock. Has the story changed? If the story has changed, is it still a good story? If not, then likely cut your losses and sell. If the story hasn't changed, you're still bullish on the company, then buy more significantly, because then I think it would alter your returns. Yes, if you'd have bought more significantly at 20% decline in best of the best, even though the story had only slightly changed, you would have lost more money. But I guess it's another way of saying keep powder dry and ready so that you can take advantage of the dips in the market. And if you'd like to see my free UK stocks to buy in August 2021, then click the card at the top right of the video. Thank you for watching. I'm Foreman. Have a fantastic day.